Hello and welcome to the latest edition of our monthly market updates. May was another difficult month in financial markets, with the crisis in Ukraine continuing to dominate the news, markets and our thoughts. High inflation and weak growth were carried over from April, with both the Bank of England and the UK government taking steps to improve the situation. The central bank raised interest rates at the beginning of May, while Rishi Sunak announced plans to try and support families for the astronomical rises in fuel costs towards the end of the month. In May, long-standing concerns around inflation gave way to concerns about economic growth. The US GDP estimates, for example, have been steadily downgraded over the past few months, impacted by expectations of higher interest rates and fallout from the invasion of Ukraine. While GDP growth is a useful indicator of the state of the economy, what we really care about when considering our portfolios is corporate earnings. Earnings are the basis of corporate revenues and, by extension, the price at which investors are willing to pay for an equity share in a company's earnings. However, we want to be able to tell what a company's earnings will be rather than what they are. For this reason, GDP growth estimates can be used to forecast the ability of companies to generate revenues in the future. Downgrades to GDP estimates haven't yet been reflected in earnings expectations. These haven't moved much for the US or Europe, while the UK has seen upgrades. Earnings forecasts may prove to be too high given downgrades to growth estimations, but time will tell on this. Fed minutes from the last Federal Open Market Committee, FOMC for short, at the beginning of May highlighted both growth and inflation worries. Sustained elevated inflation remained the driving topic for Fed policy, with a 0.5% rate hike resulting from the last meeting. Although GDP growth was highlighted as an issue, the minutes stated, household spending and business fixed investments remain strong, while the unemployment rate has declined substantially. Now, will this feeling change in the next FOMC meeting on the 15th of July? Will growth concerns start to play on investors' minds and influence the Fed's policies? We'll see on those. The April ISM manufacturing PMI for the US, which is one of the first data releases each month and is widely used as a leading indicator for the direction of the economy, came in at 55.4 for April, down from 57.1 the previous month and falling below the forecasts of 57.6. If this indicator is to be believed, by the time the FOMC meets again in June, there may be more data to support the suggestion that growth is the major problem facing the economy, influencing the Fed policy accordingly. Also in May, there was a great deal of focus on China's COVID-19 policy. Since the outbreak over 2 years ago, the world's second largest economy has adopted a zero COVID approach, aimed at halting the spread of the virus through stringent regulations. These semi-regular disruptions have naturally had an impact on the global economy. The impact of China's zero COVID approach has seen global supply chains disrupted, contributing to global inflation as the price of goods increase amid a shortage in supply. This supply-driven inflation is particularly bad for the global economy. It contributes to stagflation pressures, whereby prices increase while growth is slowing since disrupted supply chains limit the global trade. Now, whilst recent weeks have seen lockdown restrictions eased in Beijing and Shanghai, there's no reason why these semi-regular disruptions could not continue in the future and continue to hamper the supply chain for at least the rest of the year. As always, if you want to discuss anything related to financial markets or talk about your portfolios in more detail, don't hesitate to get in touch with our team of investment consultants. We'll be back in a month with another market roundup. Thank you.